There is one danger zone and one hidden opportunity in euro to US dollar today. And if you miss this setup, you'll be chasing price when the real move is already over. I'm looking at a chart structure that has trapped both bulls and bears over the last 48 hours. And right now we are sitting at the exact inflection where the next 150 pip move gets decided. I'll show you exactly where the trap is, where the invalidation sits, and I'll hand you 3 trade plans with precise entries, stops, and targets you can use instantly. Stay until the end because the third strategy is a high-risk counter-trend play that could pay 5 to 1 if the daily trend finally snaps. Right now, euro to US dollar is trading at 1.1643. You need to write this number down. If we break and close above 1.1667 on the 4-hour chart, the entire bearish structure that has dominated for 2-week shifts. That level is my session invalidation. If it goes, the daily sellers lose control and we are likely squeezing toward 1.1700 and beyond. Below us, 1.1633 is the first thin floor, but the real line in the sand is 1.1616. Lose that, and the weekly trend sell and the daily strong sell align for a waterfall acceleration. So the session bias is a bearish fade inside a range, but we fade with precision. We are not blindly shorting. We are selling into resistance levels until 1.1667 breaks. If you see a 4-hour candle body close above 1.1667, you flip, you stop selling, and you look for longs. That's the verdict. Write 1.1667 in your trading plan right now. Now let's walk the chart from the top timeframes down, because the conflict between timeframes is exactly where most traders make the fatal mistake. The monthly chart is screaming strong buy. That means the multi-year bull trend from 1.05 is still intact, and any sell-off we are seeing is a correction within that larger uptrend. But the weekly is sell, the daily is strong sell. This is a classic higher time frame tug-of-war. The weekly sell tells us that over the last 1 to 3 weeks, momentum has been with the dollar. The daily strong sell confirms that yesterday's price action closed below key short-term moving averages, and the trend on the daily is heavy. However, here's the trap. The 1-hour trend is strong buy, and the 5-hour is buy. So lower time frames are painting a bounce, a counter-trend rally, exactly when retail sees the daily sell and wants to jump short immediately. That bounce is the bait. The smart money is either using that bounce to build shorts at better prices or waiting for it to fail. So we need to understand the levels that will validate the bounce or kill it. Let's talk moving averages conversationally. The 200-day simple moving average is sitting at 1.1590, and that is acting like a magnetic floor. Notice how prices held above it repeatedly, even on the recent sell-off. The monthly strong buy is anchored to that 200 MA holding. The 50-day MA is at 1.1681 and the 100-day MA is 1.1680, so they are stacked right on top of each other. That cluster between 1.1680 and 1.1681 is the brick wall that the bulls must smash through to change the daily trend. Right now, the 20-day exponential moving average is at 1.1664. That's just above current price and aligns almost perfectly with our first key resistance at 1.1650 and the next at 1.1667. The 10-period MA is at 1.1644, and we are right on it. So we have a coiled spring. Price is pinned between the 10 MA and the 20 MA on the daily, while the lower timeframes are pushing up. The 5-period MA at 1.1613 is catching up from below, creating a rising support line. If the 5 MA crosses above the 10, that would be a short-term buy signal, but only if the daily resistance lets it breathe. On the 4-hour chart, MACD is showing something critical. The MACD line is at negative 0.001, effectively flat, but the histogram has been shrinking negative bars. This is classic bearish momentum exhaustion. Buyers are trying to step in, but they haven't yet produced a positive crossover. If MACD flips positive while price is still below 1.1667, we get a hidden bearish divergence, price making a lower high but momentum making a higher high. That would be the perfect short entry window. On the 60-minute chart, RSI is at 46.52, right in no man's land, not oversold, not overbought. That tells us there's plenty of room for a short-term rally toward resistance before sellers step back in. So the technical deep dive message. We are in a downtrend on the daily, but the bounce has not failed yet. The failure point is 1.1650 to 1.1667. That's the zone where selling pressure should resume if the trend is real. And if 1.1616 breaks, the 200 MA at 1.1590 becomes the next magnet, and a close below that opens 1.1500 now crosses that linkage. Euro to US dollar doesn't move in a vacuum. The US dollar index is a liquidity tide, and right now it's correlating directly with the S&P 500 risk appetite. When the dollar strengthens, equities often struggle, and that's been happening. But look at the dollar killers, EUR and GBP. Yesterday, we saw a subtle fracture. While Euro to US dollar bounced from 1.1616, pound sterling to US dollar actually made a new session low. That divergence screams policy differential. The Bank of England is sounding incrementally more dovish than the ECB, and that spread is giving EUR a relative bid against the pound, but it's also keeping the euro from collapsing outright against the dollar. If you watch the euro to pound sterling cross, it's rising, which means euro is outperforming sterling. For euro to US dollar, that means that any dollar strength is being partially absorbed by this euro demand against GBP. But the dollar is being driven by yields. The 10-year US Treasury yield ticked higher again overnight, and that's putting pressure on euro. Still, gold's resilience above a key zone tells me there's a geopolitical fear premium. If oil spikes on supply shock headlines, that feeds into higher inflation expectations and can actually boost the euro through ECB hawkish repricing. So the crosser set web is tense. BTC is tracking the S&P like a shadow, and both are stalling near resistance. If risk assets roll over, the dollar will catch a safe haven bid, and euro to US dollar breaks 1.1616. If they push higher, euro to US dollar can squeeze through 1.1667 and run. The last 24 hours of core news, we had a European Central Bank speaker acknowledging that services inflation remains stubborn but that the disinflation process is on track, which the market took as slightly dovish, but the euro didn't crack because US durable goods orders missed expectations, pulling the dollar back. So the fundamental driver is mixed. No clear commitment from either central bank for the next move. That creates a range until Friday's US core PCE data. The 1 to 2 week directional lean is bearish while we are below 1.1680, but I'll flip neutral above 1.1667 and bullish above 1.1700. The event that would invalidate the bearish thesis is a close above 1.1700, or a clear ECB shift to a more hawkish stance that widens rate differentials in favor of the euro. Here's what most traders miss. The trap is set exactly at 1.1650. That's a prior support turned resistance, and the 20 MA is there. If you chase the bounce there without confirmation, you get caught. Most people will skip the next part, but this is where money is made. Keep watching. We are going into 3 trade setups. I'll give you exact trigger conditions, stops, targets, and risk-reward logic. After strategy 2, I'm going to ask you a question, and I want you to type it. In the comments, strategy 1, the sniper, the conservative approach for those who want to sell into the daily trend with the highest probability. The trigger condition, wait for a 15-minute close below 1.1633, which is the first key support we already tested once. That break confirms the bounce failed and the intraday buy momentum is dead. Entry is a sell stop at 1.1631. Stop loss at 1.1668, just above the session invalidation resistance we talked about. That's 37 pips of risk. Target 1 is 1.1616, the major support, for a 15 pip gain and a risk reward of roughly 1 to 0.4 on the first target, but we scale. Take half profit there and move the stop to entry. Target 2 is 1.1590, the 200 MA, for an additional 26 pips, giving a total of 41 pips on the full position. Risk reward on the full exit if both targets hit is about 1 to 1.1. Not spectacular, but high probability because we are in the direction of the daily trend and entry is on confirmed weakness. What voids this setup? If price never closes below 1.1633 and instead pushes above 1.1650 and holds, the sniper stands aside. Patience, strategy 2, the active trader, standard risk, using a pullback into the 20-period moving average on the hourly chart. Entry condition, wait for a rally into the 1.1650 to 1.1655 zone where the 20 MA on the 60-minute sits, and look for a bearish rejection candlestick, a shooting star or a bearish engulfing on the 15-minute chart. Entry at 1.1652 with a limit order. Stop loss at 1.1672, which is 20 pips above entry and above the 1.1667 resistance cluster. That gives room for a false breakout spike. Risk is 20 pips. Target 1 is 1.1633, a quick 19 pips, roughly 1 to 1. At target 1, move the stop to break even. Target 2 is 1.1616, for a total of 36 pips, a risk reward of 1 to 1.8 on the runner. After target 1 is hit and the stop is at cost, you can set a trailing stop of 15 pips on the remaining half. The reasoning behind the stop placement, above the 4-hour resistance cluster and the daily 20 MA, so if we are wrong, the structure is broken and we want out fast. Most traders miss this. They place stops just below the resistance, getting swept by wicks. Put your stop where the bias changes. Now here's the interaction cliff. Let's see how aligned we are. Type your euro to US dollar range for the next 24 hours in the comments now. I want to see 1.16 something and 1.17 something. I'm reading them. I respond to precise levels. Strategy 3, the aggressor, high risk, counter-trend momentum chase on smaller timeframe extremes. This is only for those who know how to lose small and manage risk aggressively. If you see a 5-minute close above 1.1660 with strong bullish volume, that suggests a breakout against the daily trend and a squeeze into stops. The entry is a buy stop at 1.1662. Stop loss at 1.1644, which is just below the 10 MA and the current price, a tight 18 pip stop. Target 1 is 1.1680. The 50 MA, 418 pips and a 1 to 1. Target 2 is 1.1700, another 20 pips, total 38 pips. Risk reward 1 to 2.1. This is countertrend, so if the breakout fails and reverses hard, you're out quickly. The invalidation is a 15-minute close back below 1.1650. Explicit warning. Only take this if you have already banked profits this week and you are comfortable with a 50% probability at best. Never risk more than 1 to 2% per trade. No positions through high-impact news events like US PCE or ECB press conferences. Stops are non-negotiable. If 1.1667 breaks, you honor the stop and reassess. Don't marry a bias, now the close and retention loop. The single most critical level for the next session is 1.1616. If we close below that on the 4-hour, the short trend accelerates and the monthly 200 MA at 1.1590 becomes the immediate magnet. If we hold above 1.1616 and break 1.1667, we are in a squeeze mode towards 1.1700. Tomorrow I'm focusing on the US core PCE deflator, which will either validate the dollar strength or shatter it. I'll break that down live and show you how it impacts gold and Bitcoin correlation. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage across all 8 assets. I'll see you in the next one.